Hi, welcome back. In this session, I'd like to talk about an upcoming IPO, an IPO that I'm sure that you've heard of, and is a high-profile IPO, another one of those social media companies going public at valuations that most people have trouble grappling with. The company is a company called Snap, and of course, it used to be called Snapchat. And I'll give you a little bit of history because, in a sense, the history I have with Snapchat is almost as old as the history of the company itself. The company itself was founded in 2011 by a couple of Stanford students, Evan Spiegel and Bobby Murphy, who thought it'd be a good idea to actually create a social media site where people could share pictures that disappeared after you saw them. You think, why would you want pictures that disappear? Well, let's face it, we all have impulse control problems sometimes, and when we take pictures and we send them to people, sometimes we regret what we've done, and with Snapchat, those pictures disappear. The first time I heard of Snapchat was actually in 2012 when my daughter came to me and she said, "Dad, do you have Snapchat?" And I said, "Snap what?" And she, of course, classified me as old automatically, but then she explained to me that Snapchat was this app that you could use to share photos. And since she sent out so many Snapchat photos to people, I decided that I would in fact download Snapchat because that's the only way I could keep track of what my daughter was doing. And in the years since, Snapchat has grown. It's dropped the chat. In fact, it was born as Peekaboo, the original name of the company, became Snapchat. It dropped the chat somewhere along the way, became Snap. Well, I knew the company had arrived, not when my daughter told me about the company, but when Facebook announced that it was trying to buy Snapchat, or actually there were rumors that Facebook was trying to buy Snapchat for $3 billion. That was a surprisingly large number. What was even more surprising was when the founders of Snap turned them down. And I'm sure there were people who looked at that and said, "Are you crazy? You're turning down an offer for $3 billion? You could be wealthy beyond your wildest dreams. And you have a company that has no revenues, no profit. So in any conventional intrinsic value measure, you'd say, why would you not take $3 billion? Well, it looks like the founders of the last laugh, because in the years since, Snap's enriched its ecosystem. It brought in Snap Stories, then geofilters, and in fact, last year they introduced these glasses you could wear that could record video called Spectacles. But the culmination of all of these developments was in February 2017 when they announced that they plan to go public. Now, actually, they announced in December, but they're going to go public in February 2017. And at this point in time, Snap looks like a successful social media company, at least in terms of not just attracting users. They had 161 million users as of November when they filed the prospectus. But more critically, these users are very engaged. Snap is actually second only to Facebook in terms of the time that people spend on the Snap ecosystem. So this is where we are with Snap. The company is going to be, the pricing was just announced yesterday at $18.5 to $21.5 million. And I'd like to take a look at, if I were valuing this company, how I would go about valuing the company. And I want to emphasize that this is my story and my valuation. And I will lay the framework for you to completely disagree with me and come up with your own story and your own valuation of Snap, the company. So let's start off by looking at how Snap describes itself. The very first line of its prospectus, the S1 that it filed with the SEC leading up to its offering, says Snap is a camera company. But is it? When I think of camera companies, I either think of the old camera companies, Kodak, Polaroid, which are pretty much dead in the water, or even the Japanese names, the Pentax, the Fujis, which are dying slowly from disruption coming from smartphone cameras and the new players in the market. If I think about the newer players in the market, I think of GoPro, a company that you can consider a disruptor but can't figure out how to make money. So I don't know whether I'd want to classify myself as a camera company. This is not the most successful space in the world, and I'm not sure Snap is a camera company, and here's why. It actually doesn't sell cameras, it doesn't sell photos. It really is, to me, a photo company, a picture company, a visual company. A company that in the social media space is really centered on the visual. And I think that's part of what the message is in Snap calling themselves a camera company. In the social media space today, I think the problem is if you're a company that does not have a niche, a particular way of defining yourself, you're going to become a Me Too company. So when I think about the social media players, I think of Facebook as primarily a posting company. And you post to your friends, and of course you can post videos and pictures now, but it's built around the posts. I think of LinkedIn as a business networking social media business. That's where you go if you want to network for business. And I think of Twitter as the place you go when you want to send a message. It's a punchy message and you want to get to a lot of people very quickly. So if your timeliness matters, Twitter is where I'd go. I think of Snap as the place you go if you're a visually oriented person and you want to share pictures and videos. And that's what they're trying to carve a niche for themselves out. We'll see whether that's going to hold up as Facebook pumps up Instagram as a competitor. But that's what I see when I think of Snap as a company. Now, building on that, let's think about how Snap makes money. Snap doesn't make money from selling hardware. I know they have these eyeglasses, spectacles that they're pushing to the market, but I don't see it as a way in which Snap hopes to make money. The way I see spectacles is I think it is a way in which Snap wants to keep users more engaged on their platform, keep you on more, and sell you more ads. So it's ultimately going to make money in advertising. Which means to value Snap, we have to understand the advertising market, in particular, the subset of the market that's digital advertising. In this graph, you can see both the good news and the bad news of the digital advertising market. The digital advertising market is growing. It's growing often at the expenses of old-time advertising because in this graph you see me graph out both the total advertising market in the blue columns and the portion of it that is digital advertising. In 2016, the entire digital advertising market was about $200 billion and it was about 30% of the entire advertising market. And that 30% is clearly a climb up from where it was 5 years ago. And over the next 4 years, this trend is expected to continue. By 2020, the digital advertising market, or 2019, the digital advertising market is expected to be about $300 billion, and the overall advertising market is about $700 billion. So one trend is clear. Digital advertising is becoming a larger and larger percentage of overall advertising, which gives these digital advertising companies a chance to grow. Now, within the digital advertising company, there's another trend that's kicking in. Mobile portion of the digital advertising business is growing exponentially. It used to be 3 to 4% of the overall digital advertising market in 2011. It's expected to be more than 64% of the digital advertising market in 2019. So that sets a table. This is a big market. Digital advertising is a big market. It's a growing market. And the question is, where do I see Snap fitting in this market? Now, before I go there, let's look at who the big players in this market are. It's no contest. If you add together Facebook and Google, you're essentially at 43% of the market. They're the two big players, and everybody else is fighting for the crumbs. In China, Baidu and Alibaba managed to control a chunk of the market, partly because the Chinese market is big. But if you look at the US market, it's Google and Facebook and then everybody else. In fact, what's even scarier is if you look at the growth that happened in 2015 and 2016 in the digital advertising market, about 60% of that growth went to Google and Facebook. So not only are these companies big, they're getting bigger. So the question becomes, where will Snap fit in this market? Now, before I go there, let me kind of review a theme that I've kind of repeated in the past and I'll repeat again. When you value a company, you need a story. And when you value a young company, the story is really what's driving the valuation because there's no history to this company. There are no financials you can build it off. It's your story that's going to drive the valuation. As a company ages, the numbers clearly start to become a bigger part of the story. So if you listen to my session on Apple, you notice how much of the story was driven by the numbers. I had to stay disciplined. I was in chapter 33 of a 35 chapter book. Here I'm in chapter 1. So the good news is I get a chance to tell my story and I'm relatively unconstrained. The bad news is I get a chance to tell my story and I'm relatively unconstrained. So I can basically tell you a fairy tale. So here is my setup for Snap. I first looked at how Snap looks relative to some other big online advertising companies at the time that they went public. So what you have here are Google, which was the big player, the oldest player in this market, LinkedIn, Facebook, and Twitter, which are the social media players, and the dates of their IPOs. Google, of course, went public in 2004. LinkedIn, Facebook, and Twitter went public in 2011 through 2013. If you compare where Snap is relative to these companies, here's what I see. Snap actually has less revenues than any of these companies other than LinkedIn. And it's actually losing more money than any of these companies. You see, this is awful. The good news, though, is Snap might have fewer users than Twitter and Facebook did when they went public, but it clearly has more engagement than either Twitter or LinkedIn at 25 minutes. So the good news for Snap is they have a lot of engaged users. The bad news is they don't have much on the ground right now to reflect that usage. So I get a chance to tell my story. In my story, here's what I think will happen. I looked at the potential ways in which these companies could evolve by looking at the 4 companies that are already public and looking at their history since their IPO. Google and Facebook, of course, are your success stories here. Google, because it's been able to maintain double-digit and high double-digit revenue growth for a decade after it went public, and while maintaining margins that, while they've come under pressure, are still very healthy, 25.6%. Facebook, of course, has beaten even Google in terms of how quickly it's grown, and its margins are even higher than Google's are. So Google and Facebook are your winners. The biggest loser in this group, of course, is Twitter, a company that's been able to grow revenues, albeit at a rate lower than people thought it could, but has not figured out a way to monetize its user base. It's still losing money at a pretty substantial pace. LinkedIn falls in the middle. Its revenue growth is not Facebook levels, but it was a little better than people thought it was going to do. But it was actually able to make money primarily because of its LinkedIn premiums. But the margins are much tinier, than the margins for Google and Facebook. So here's a broad choice. Do I think Snap is going to go the Facebook-Google route, or do I think it's going to end up like Twitter at the other end? I think it's going to fall in the middle, and here's the story I will tell for Snap. I'm not sure if this is the story that the company will play out or whether it's a story that its founders want to tell. I see Snap primarily as an online advertising company. I don't see its hardware, eyeglasses, becoming a big source of revenues. I see it focused on a subset of the market, a young tech-savvy crowd, and that's not a small subset. That's a pretty large portion of the online advertising market, but they're going to stay focused there. They're not going to try to be everything for everybody like Facebook and Google are. And it's, as I see it, the company is going to be more focused on delivering user minutes than number of users. Unlike LinkedIn and Twitter that got caught up in the number of users game, I see Twitter framing the game as we want to keep users more engaged in our platform than getting more users. Part of that comes from the fact that Snap, unlike Twitter and LinkedIn and Facebook, actually pays for service space with new users. So users cost them money adding users. So they'd rather engage users more. And I think that emphasis plays out both in the way they invest, the kinds of technologies they are on, and what they invest in. So with that story, here's what I get as my numbers. Because I don't see them as a Facebook or a Google type, everything for everybody, their revenues are going to be capped. In fact, with my revenue growth of about 55% for the first 5 years, kind of scaling down after that, I see them having revenues of about 10 billion by 2026-27. Not bad, right? 10 billion, but only 10 billion, not the 50 or 60 billion you're going to see for Google or Facebook. I see them as, and the plus of having this focus is I think they're going to be able to deliver profit margins much higher than Twitter and LinkedIn. Perhaps not to Facebook levels, that's 40-45%, but I think they'll get to Google levels. So my target operating margin is going to be about 25%. Now, as they start to make money, they will have to pay tax, and I'm going to assume that that tax rate is going to converge on what I see as the marginal tax rate for U.S. companies after the tax code changes of 30%. And the reinvestment they're going to make, I think they will be very much like the other companies in this space that seem to have to invest about for every dollar they invest. And the investment is going to take the form of acquisitions of new technologies. And in the case of Snap, it's going to take the form of buying service space, which is what they are reserving cloud space. They're actually down for about $2 billion that they're going to set aside to pay Google for cloud space. So that sales to capital ratio of 2 basically means for every dollar of capital, they get $2 of revenues, and that's going to determine reinvestment. And because they're going to stay in online advertising business, in my story, I'm going to give them the kind of cost of capital that online advertising companies have, which is about 9.94%, which puts them at about the 85th percentile of all U.S. companies. That'll scale down over time, but if they don't make it, and there's a chance they will not make it, they're still a young company losing money, I'm going to attach a 10% chance of failure. Couple of final loose ends. One is the fact that that this is an IPO and cash is going to come into the company, and when cash comes in, that cash is going to add on. And the rough estimate is they're going to raise about $3 billion from the offering, which will add to their cash balance. So that goes into the cash that I will add on to get to the value of equity. In fact, clarifying the IPO details, looking at their prospectus, it looks to me, and there are lots of different layers of stock share counts here. Not only do they have 3 different classes of shares with different voting rights, they have restricted stock units and options. My estimate is they have 1.24 billion shares outstanding, or will after this IPO, and about 44 million options outstanding with an average exercise price of $233. And the IPO itself is going to bring in $3 billion. With that put in, here's what I get as my base case valuation. So the revenues go to about 10 billion, the margins improve to about 25%. The value per share that I see the company converging on is about 11, basically the value of equity is about 14.3 billion, including the 3 billion from the proceeds, which translates, if you trust my share count, to about $11 per share. That's not an insubstantial number for a company that has $500 million in revenues, and it's losing more than that right now. But given my kind of focused story of a visual company staying in the online advertising space, that's a value that I get for the company. Now, of course, all of the estimates I'm making are just estimates. I could be wrong about them. So I decided to flesh out the uncertainty I had about my estimates by starting with 4 big estimates: the revenue growth number, the margin number, the cost of capital, and the probability of failure. The revenue growth number, I've used 55% as my base case. I looked at a range of revenue growth from 35 to 75. At 75% revenue growth, their revenues in year 10 will be about 25 billion. At 35% revenue growth, they're going to be closer to 4 billion. So, I mean, that's a big range in revenues. The margins, my base case was 25%, but I looked at ranges from 10 to 40%. 10 would put them in LinkedIn territory. 40% would put them in Facebook territory. And I also assumed that if the margins were high, the revenue growth was also probably going to be high, because there's a correlation between those two. Now, for the risk measures, the cost of capital I used was 9.94%, but I looked at ranges from my low point of 8.4 to 11.4%. And I also assumed the probability of failure of 10% that I have would increase, especially if they ended up with a high cost of capital. It could get up to 20-25%, and that correlation captures the link between the two. With those assumptions about my inputs, I was able to estimate the potential value outcomes of Snap. So if you remember, the value that I got in my base case was about 14 billion. This is the distribution of values. The average value that I get across all of my estimates is about just over 14.5 billion, which is pretty close to my base case. My median value is about 13.3 billion. This is a company where, and this might make it attract investors, where the possibility of big positive outcomes is high. There's an optionality if you look at the tail of the distribution. But you can see the range of values here, reflecting the range of stories. At worst case, the company could be worth less than nothing. Its best case, it could be worth 40, 50, 60 billion dollars. In fact, if you look at there are 2 alternative stories you could tell about Snap. One is what I call the Facebook Lite story, where they kind of go after a bigger market than I'm projecting. And with that bigger market, not quite the size of I'll call it Facebook Lite for that reason. I'm going to end up with about 25 billion in revenues, an operating margin of 40%, Facebook-like margins. I end up with a value for the equity of 48 billion. At the other end of the spectrum that I call Twitter Redux, well, what you get is much slower user growth, less user intensity, lower margins, 4 billion in revenues with a margin of 10 to 15. Actually, it should be 10% in steady state. I end up with a value for the equity of about 4 billion. And you're saying, well, that's any number goes. No, any number doesn't go. Your value will reflect your story. You have to decide, if you're investing in Snap, what your story is. Now, of course, the pricing is, as I said, it's just been set at 18.5 to 21.5 billion. That's a little higher than my estimate. You could ask me why, but I've never felt the urge to explain what other people pay. But remember, bankers price companies. They don't value them. See, what's the difference? Value is based on cash flows, growth, and risk, what we've talked about in the DCF. Price is based on what people will pay. So here's a little thought exercise. If people are willing to pay 12 billion for Twitter, a company that seems incapable of converting users to profits, and Microsoft is willing to pay 26 billion for LinkedIn, a company that's margins seem to stagnate at 5%, well, why shouldn't you pay 20 billion for Snap, a company that has much higher user intensity than Twitter and LinkedIn? Pricing is relative. You don't have to show me the cash flows and the revenues. You just have to show me that Snap is priced okay, is priced reasonably relative to the other companies in the space. And that's what you're going to see the bankers say. Now, whether you buy into that or not will depend on, are you an investor? Are you a trader? If you're an investor, you buy based on value. You've got to tell a story and justify the value. If you're a trader, you're buying at 20 billion, you're hoping to flip to somebody else at 25 billion. Different game, different set of issues. So ask the right questions, make your own judgment, tell your own story about Snap. This is going to be a fun company to watch. I like the company. I like the way the founders have framed the company. Let's see how the rest of the story plays out. Thank you very much for listening.